I want you to think carefully about a simple question because simple questions are often the best way to see a complex system clearly. What is the value of a $100 bill? Most people would say the answer is obvious. It is worth $100. But that answer hides the real issue. $100 is not a fixed amount of wealth. It is a claim on goods and services. It is a unit of trust. It is a promise that other people will accept it tomorrow for the things you need. What that $100 buys today is not what it bought 5 years ago. And it is certainly not what it bought 50 years ago. That same number on the paper represented far more purchasing power. It could buy more food, more fuel, more labor, more shelter, and more real things. So the question is not whether the number printed on the bill changed. The number stayed the same. The system behind the number changed. And now that system may be changing again. That is why the news that the United Arab Emirates is leaving OPEC after roughly 60 years matters more than most people realize. Most people are looking at it as a Middle East story. They are asking what it means for oil quotas, production levels, regional politics, and energy prices. Those questions matter, but they are not the deepest question. The deeper question is what this means for the dollar, because the dollar did not become the center of the world by accident. It became the center of the world because it was connected to trust, power, oil, military protection, global trade, and the ability of the United States government to borrow cheaply for decades. When one of the major oil producers begins moving away from the old structure, you should not treat it as a random headline. You should treat it as a signal. And when you look at the dollar as a system, not as a piece of paper, you begin to see why this signal matters. Before 1971, the dollar was connected to gold. That did not mean the system was perfect. No monetary system is perfect. But it did mean there was a constraint. If a government wanted to spend far more money than it had, it could not simply create unlimited wealth by creating unlimited currency. The currency had to relate back to gold, and gold could not be printed. That constraint mattered. It created discipline. It limited what politicians could promise and what central bankers could accommodate. Then, on the 15th of August 1971, President Richard Nixon suspended the convertibility of the dollar into gold. At the time, the word used was temporary. Temporary is a very interesting word in government policy. Many things that begin as temporary become permanent because they make life easier for the people managing the system. Here we are more than half a century later, and the temporary suspension became the foundation of the modern dollar system. After 1971, the dollar was no longer backed by gold. It became fiat currency. That means the dollar is backed by confidence. It is backed by the power of the United States government. It is backed by the legal system, the tax system, the military system, the banking system, and the belief that other people will continue to accept it. This is not a small change. It is one of the most important changes in modern economic history. When money is backed by something you cannot print, the system has one kind of risk. When money is backed by trust, the system has another kind of risk. Trust is powerful. It can hold a system together for a very long time, but trust must be maintained. If it is abused, it weakens. If it is weakened long enough, people begin searching for alternatives. That is what we are watching. Now, a few years after the gold link was broken, the United States built another support structure for the dollar. That structure was the petrodollar system. In 1974, the United States made an arrangement with Saudi Arabia. Saudi Arabia was one of the most important oil producers in the world. Oil was the critical commodity that every modern economy needed. Without oil, ships do not move, factories slow down, trucks stop, militaries weaken, and economies lose oxygen. The arrangement was simple in principle. Saudi Arabia would sell oil in dollars and recycle much of its oil revenue back into U.S. Treasuries. The United States would provide weapons, military protection, and political support. That created a very powerful loop. Countries around the world needed oil. To buy oil, they needed dollars. To get dollars, they had to trade, save, borrow, or hold dollar reserves. Oil producers received dollars. Then those dollars flowed back into the United States through the Treasury market. The U.S. government could borrow at lower rates because the world had structural demand for its debt. The dollar was no longer backed by gold, but it was supported by oil demand, military power, financial depth, and global habit. That is how systems become durable, not because everyone loves the system, because everyone needs the system for decades. This arrangement gave the United States what economists call an exorbitant privilege. It allowed America to import real goods and export paper claims. It allowed the United States government to run large deficits and still find buyers for its debt. It allowed American consumers to enjoy stronger purchasing power than they otherwise would have had. It allowed the dollar to remain the world's reserve currency even after the gold link was gone. If you are trying to understand the modern world, you must understand that the dollar is not just a currency. It is a network. It is a settlement system. It is a savings tool for central banks. It is the currency of global oil. It is the unit used to price debt, trade, commodities, and financial assets. And when a network like that begins to lose exclusive control, the change can be slow at first and then faster later. That is why I pay attention to the UAE leaving OPEC. It is not because one announcement ends the dollar. That is not how systems die. Systems usually do not collapse because of one headline. They weaken through a sequence of small breaks that change incentives. First, people question the system, then they test alternatives, then they build parallel rails. Then what once looked impossible becomes normal. The petrodollar system ran quietly in the background for decades. Most people never studied it because they never needed to. They were paid in dollars. They saved in dollars. They bought houses in dollars. They watched the stock market in dollars. They assumed the dollar was simply the natural center of the world. But reserve currency status is not a law of nature. It is a result of incentives. When the incentives change, the system changes. And the incentives began changing very clearly after the pandemic. In 2020, the United States government spent enormous amounts of money it did not have. Unemployment checks, stimulus checks, PPP loans, emergency programs, bailouts, liquidity facilities, rescue packages. Some of that may have been necessary to avoid an immediate economic collapse. But necessity does not eliminate consequences. When a government spends money it does not have, it must borrow it, tax it, or create it. When it creates money through the central banking system, the number of dollars rises. But the amount of real wealth does not rise. Just because the number of dollars rises, you can print more dollars. You cannot print more oil. You cannot print more copper. You cannot print more productive labor. You cannot print more trust. This is one of the great principles people forget during easy money periods. Currency can be created quickly. Wealth is created slowly. When currency grows much faster than wealth, the value of each unit of currency is pressured. That is what inflation reveals. Inflation is not just higher prices. It is the loss of purchasing power in the unit of money. If $100 buys less, the number is unchanged, but the reality has changed. Other countries watched this. They saw the United States print and borrow on a historic scale. They asked a rational question: if the reserve currency issuer can create trillions of dollars when it needs to, should we keep organizing our entire economy around that currency? That question did not destroy the dollar, but it weakened the assumption that there was no alternative. Then came the Russia-Ukraine conflict. After Russia attacked Ukraine, the United States and its allies froze and seized Russian assets held in dollar and Western financial channels. Many people in the West saw that as a punishment for aggression, but the rest of the world also saw something else. They saw that reserves are not just financial assets, they are political assets. If your reserves are held in a system controlled by someone else, and that someone else decides you are outside the acceptable political line, those reserves can become inaccessible. That is a major risk management lesson. Countries do not need to approve of Russia to understand the implication. They simply need to ask, if it happened to Russia, could it happen to us one day? And once a central bank asks that question, it starts thinking differently about reserves. It starts thinking about gold. It starts thinking about local currency settlement. It starts thinking about bilateral trade. It starts thinking about payment systems outside the dollar network. It starts thinking in probabilities, not loyalties. That is what large systems do when they feel risk rising. They diversify. They do not abandon the old system overnight. They reduce dependence. That distinction matters. I am not saying the dollar disappears tomorrow. That would be naive. The United States still has the deepest capital markets in the world. It has a powerful military. It has a huge consumer base. It has innovative companies. It has legal and financial infrastructure that remains extremely important. The dollar is not going to zero because the UAE leaves OPEC or because some oil is traded in yuan or rupees. But the unchallenged monopoly of the dollar is being questioned. That is a different statement, and it is the more important one. In 2001, roughly 72% of global currency reserves were held in US dollars. By the end of 2025, that share was around 56%. That is still dominant, but it is not the same dominance. A decline from 72 to 56 is not a collapse. It is a trend, and trends matter because they show the direction in which incentives are moving. When you see the reserve share fall, when you see oil producers accept alternative currencies, when you see central banks buy gold, when you see countries build non-dollar payment channels, you are looking at the same underlying behavior. The behavior is diversification away from dependence on one system. Now bring China into the picture. China and the United States have been competing economically for years. The United States still has the larger economy, but China has grown rapidly and has become the largest customer for many commodity producers. China buys oil from the Middle East. China buys oil from Iran. China has bought oil from Venezuela. China has every incentive to reduce its dependence on the dollar because using the dollar keeps it tied to a system controlled by its biggest strategic competitor. So China began building its own commodity settlement infrastructure. It created oil futures priced in yuan. It pushed for more trade in its own currency. It built relationships with major oil producers. Then, in 2023, Saudi Arabia, the country that helped build the Petrodollar arrangement, began selling oil to China in Chinese yuan. That did not end the dollar, but symbolically and structurally it mattered, because it showed that even the original pillar of the petrodollar system was willing to experiment with alternatives. Once that happens, the mental barrier is broken. The first time a system changes is the hardest, the second time is easier, the third time becomes a trend. Now we are watching the UAE. The UAE has been vocal about de-dollarization. It has worked with countries such as India on oil trade outside the dollar. It has wanted more flexibility and more control. OPEC is a group of oil producing countries that coordinate production, and for decades the broad oil system has been deeply connected to dollar settlement. If the UAE leaves OPEC and moves further toward independent pricing, independent production, and independent settlement relationships, that is not just an oil story, it is a dollar story. Because oil is one of the deepest sources of structural dollar demand. If oil gradually becomes more multi-currency, the dollar loses part of that automatic demand. Again, this is not an overnight collapse. It is a slow change in the plumbing, and changes in plumbing matter more than changes in slogans. Most people focus on the dramatic headline. The smarter way is to focus on the mechanism. The mechanism is this: the dollar has value because people trust it, use it, save in it, borrow in it, trade in it, and need it. If fewer countries need it for oil, fewer countries recycle oil profits into treasuries, fewer central banks hold reserves in dollars, and more trade moves into local currencies, the dollar's relative privilege weakens. That can affect us borrowing costs. It can affect inflation. It can affect the purchasing power of wages. It can affect the stock market. It can affect gold. It can affect international diversification. It can affect energy and defense. And most people will not understand it until they feel it in prices. That is usually how macro changes reach ordinary people. They do not arrive as a clean explanation. They arrive as higher grocery bills, higher gasoline prices, more expensive imports, volatile markets, and a feeling that the paycheck does not stretch the way it used to. If you understand the system before that happens, you can think more clearly. That does not mean you panic. Panic is a bad strategy. It means you prepare. Preparation is different from prediction. Prediction says, I know exactly what will happen. Preparation says, I do not know exactly what will happen. But I understand the range of outcomes, and I will build a portfolio that can survive more than one environment. That is how I think about this. The first area to understand is gold. Gold is not a business. It does not produce earnings. It does not pay dividends. It does not innovate. It does not build factories. It simply exists. That is why many people misunderstand it. They try to evaluate gold like a growth stock. That is the wrong framework. Gold is a hedge against the failure or weakening of trust in paper currency systems. When people are comfortable with the dollar, gold may do poorly or sit still. When people become concerned about inflation, deficits, sanctions, reserve risk, or currency debasement, gold often becomes more attractive. This is why gold rose after the 2008 crisis. Governments and central banks created enormous amounts of money to stabilize the system. People became worried that the dollar would lose value. Gold benefited then. When the crisis fear faded and the dollar system remained intact, gold weakened for years. After 2020, when the money printer was turned back on at historic scale, gold strengthened again. Then central banks around the world became major buyers. This is very important. When individuals buy gold, it can be emotion. When central banks buy gold, it is often risk management. Central banks are not buying gold because they enjoy shiny objects. They are buying it because gold has no counterparty risk. It is not someone else's liability. It cannot be printed by a foreign central bank. It cannot be frozen in the same way a digital reserve held in another country. Banking system can be frozen. It is imperfect, but it is independent. That independence becomes more valuable in a fragmented world. This is why gold should be thought of as a hedge, not as magic. Gold can go down. Gold can be volatile. Gold can underperform productive assets for long periods. But in an environment where the dollar's monopoly is weakening and central banks are reducing reliance on one currency system, gold deserves attention. You can hold physical gold. You can use gold ETFs. You can look at gold miners. Though miners are businesses and carry operational risk, the vehicle matters less than understanding the role. Gold is not there to make you feel clever. It is there to preserve optionality when trust shifts. The second area is international investing. If the world is gradually becoming less dollar-centered, then it makes sense to at least understand what exists outside the United States. This does not mean abandoning America. That would also be a mistake. The United States still has extraordinary companies, deep markets, and powerful innovation. But concentration is risk. If all your income, all your savings, all your investments, all your retirement accounts, and all your future plans are tied to one country, one currency, and one policy path, you should be aware of that concentration. International diversification is one way to reduce it. There are broad international funds that give exposure to many countries outside the United States. There are developed market funds, there are emerging market funds, there are country-specific funds. Each has risks. Emerging markets can be volatile. Foreign currencies can move against you. Political systems can be less predictable, but if countries are trying to strengthen their own currencies, expand their own commodity relationships, and grow outside the dollar system, some of those economies may create opportunities. The important thing is not to chase a story blindly. The important thing is to understand why diversification may matter more in a world where the dollar's privilege is less absolute. The third area is energy. If the petrodollar system is changing, oil is not just a commodity, it is a strategic asset. Energy independence becomes more important when trade routes, settlement currencies, and geopolitical alliances are changing. If the United States wants to reduce vulnerability to foreign producers, there can be more attention on domestic energy production that can benefit oil and gas companies. It can benefit infrastructure. It can benefit pipelines. It can benefit companies tied to the ability to produce, move, refine, and export energy. Energy is cyclical. It can be volatile. It is affected by politics, supply, demand, wars, and technology. But in a world where the oil pricing system is being questioned, energy exposure may matter. Not because oil always goes up, because energy sits at the center of the system. The fourth area is defense. This is the area many people do not like to talk about. But markets do not care about emotional comfort. When geopolitical tension rises, governments tend to spend more on defense. If the Middle East becomes more unstable, if the dollar system becomes more contested, if great power competition increases, defense budgets often rise that can benefit aerospace and defense companies. This does not mean you have to like war. It does not mean you have to invest in defense if it violates your moral framework, but you should understand how capital markets think. Investing has to make financial sense, legal sense, and moral sense for you. The moral part is personal. The economic mechanism is observable. The fifth area is the United States itself. This may sound contradictory after everything I have said, but it is not. A weakening monopoly does not mean a collapsing system. The United States remains one of the greatest economic engines in the world. Its stock market is still home to many of the most productive and profitable companies ever created. Technology, healthcare, finance, consumer brands, energy, defense, logistics, software, and innovation still exist at massive scale in America. So the answer is not to say the dollar has risks, therefore sell America. That is simplistic thinking. The better answer is to recognize the risks and diversify intelligently. You can own U.S. equities and still own gold. You can own U.S. companies and still have international exposure. You can benefit from American innovation and still hedge against dollar debasement. You can respect the strength of the current system while recognizing that no system is permanent. That is how mature investing works. It is not ideology, it is balance. The mistake most people make is they think in extremes. They hear the word dollarization and think the dollar is going to collapse tomorrow. That is usually wrong, or they hear that the dollar is still dominant and think nothing can change. That is also wrong. The real world usually moves between extremes. The dollar can remain dominant while becoming less dominant. The United States can remain powerful while losing some privilege. Gold can be useful without replacing productive assets. International markets can matter without being superior to America. Energy and defense can be opportunities without being the whole portfolio. What matters is understanding the direction of the system. The dollar's value rests on trust. The petrodollar system created structural demand for that trust. The pandemic money creation weakened confidence in the discipline of that system. The freezing of Russian reserves created fear that dollar reserves could be weaponized. China has been building alternatives. Saudi Arabia has tested yuan oil sales. The UAE has pushed de-dollarization and is now stepping away from OPEC. Central banks have been buying gold. Global dollar reserves have declined from their peak share. None of this means the end happens tomorrow. All of it means the system is changing. When systems change, you do not want to be the last person, still believing the old rules are permanent. The average person does not study reserve currency systems. The average person does not study how oil supports the dollar. The average person does not study how central banks allocate reserves. The average person simply feels the result later. They feel it when imported goods cost more. They feel it when savings lose purchasing power. They feel it when the market rotates. They feel it when geopolitical risk changes energy prices. They feel it when the safe thing they trusted is no longer as safe as they assumed. That is why education matters. Not because it gives you certainty, because it gives you the ability to see cause and effect. The world is a machine made of incentives. Oil producers respond to incentives, central banks respond to incentives, governments respond to incentives, investors respond to incentives. If the incentive to hold dollars weakens at the margin, you should watch what countries do, not just what they say. If they talk about de-dollarization but keep buying treasuries, that means one thing. If they talk about de-dollarization and buy gold, build local settlement systems, accept yuan or rupees for oil, and reduce dollar reserve share, that means something else. Follow the actions. Do not get distracted by the noise. This is also why I do not think the right response is fear. Fear makes people sell the wrong things at the wrong time. Fear makes people chase assets after they have already moved. Fear makes people turn a real structural shift into a doomsday fantasy. The right response is principles. The first principle is that purchasing power matters more than nominal dollars. The second principle is that concentration risk grows dangerous when the system changes. The third principle is that productive assets still matter. The fourth principle is that hard assets can protect against currency debasement. The fifth principle is that no hedge is perfect. The sixth principle is that you must think in probabilities, not certainties. If you think this way, the story becomes clearer. The UAE leaving OPEC is not a single isolated event. It is another sign of a world moving away from a single-pole dollar system toward a more fragmented and multi-currency system. The old system was built on the dollar, oil treasuries, and American protection. The new system is not fully built yet. That uncertainty is what makes the transition unstable. Transitions are where mistakes happen. They are also where opportunities appear. Gold may benefit when trust in paper currency weakens. International assets may benefit if capital looks beyond the United States. Energy may benefit if the struggle for oil and independence intensifies. Defense may benefit if geopolitical tensions rise. American equities may still benefit because great companies can compound through changing systems. The question is not which one asset is perfect. The question is how to build a portfolio that does not depend on one perfect outcome. That is the difference between speculation and strategy. Speculation says, I know exactly what will happen next. Strategy says, I know the system is changing, so I want exposure to the forces that are most likely to matter, and I want protection if I am wrong. That is how I would think about the end of the petrodollar era. Not as a single day, not as a panic headline, not as a collapse story, as a long structural transition from a world where the dollar was the unquestioned center of energy trade to a world where the dollar is still important, but less automatic, less exclusive, and more contested. Most people will not notice the change while it is happening. They will notice it after the prices change, after the charts move, after the headlines become obvious, after the institutions have already repositioned. That is usually how wealth transfers occur. The people who understand the mechanism early do not need to predict every detail. They just need to avoid being trapped in the assumptions of the old system. So when you hear that the UAE is leaving OPEC, do not only ask what it means for the Middle East, ask what it means for oil, ask what it means for dollar demand, ask what it means for treasury recycling, ask what it means for gold, ask what it means for international diversification, ask what it means for energy independence, ask what it means for defense spending, ask what it means for your savings, your wages, your investments, and your purchasing power. Because the most important changes in money rarely arrive with a sign that says, the system is changing today. They arrive quietly, then slowly, then all at once. And by the time everyone agrees that the old system has changed, the best opportunities are usually already gone. That is why you study the machine before the machine breaks. That is why you do not blindly trust a dollar just because it has worked for most of your life. And that is why you do not abandon it blindly either. You study it, you understand what supports it, you understand what is weakening it, then you position yourself with discipline. The dollar has been through multiple transitions. Gold-backed money became fiat money. Fiat money became supported by oil and treasury recycling. Now that oil system is becoming more fragmented. This does not mean the dollar is dead. It means the rules are changing. And when the rules change, the people who understand the old rules and the new incentives have a much better chance of protecting what they have built. That is the real point. Do not obsess over the headline. Study the structure underneath it. Because the headline is UAE leaves OPEC. The deeper story is that the world is testing how much it still needs the dollar. And if that test continues, the consequences will not stay in the oil market. They will move through currencies, bonds, inflation, gold, stocks, energy, defense, wages, savings, and every household that still thinks $100 is always just $100. It is not. It is a claim on trust. And trust is the most important asset in the entire monetary system. Once you understand that, you understand why this story matters.